This is retired Revenue Officer McGarry, and we are talking tax smart. You know, you've heard me often say, particularly at the end of a time, for example, that our tax system is based around the philosophy: if you're going to play, you need to pay. And so I'd like to give a little bit of an explanation to that today, and then talk a little bit about the basics of how our system is set up so that the Internal Revenue Service can be able to accommodate the various types of individuals or businesses, for that matter, or a combination of both that they deal with in regard to our tax system. So let's begin by talking about the issue of if you're going to play, you need to pay. So this is actually a little bit complex, and I may do this in two sessions, just because it may turn out to be a little bit long. But let's deal with the first one. The first one is that the Internal Revenue Code, which is what governs how it is that we look at our taxes, the Internal Revenue Code basically says that, first of all, if you're a U.S. citizen or a resident of the United States, then you are taxed on all income. So all of your income is taxable, and that's worldwide income, by the way. So, for example, if you lived overseas, if you're a U.S. citizen and you live overseas, while there are some provisions for the fact that you live overseas and some criteria that have to be made, you still are required to file a tax return, and you still are required to, if you meet the parameters, pay tax on the income that you have. It doesn't matter how old you are, how young you are. So, for example, if you see little babies, for example, that are doing commercials, those little babies that are in commercials, that's not free. Their parents are being paid, and there are provisions within the tax code that either the child itself would file a tax return, or the income from what the child makes would be included in the parent's return. And there's a mechanism for you to be able to do that. It doesn't matter how old you are, whether you're a child or you're an old man or an old woman. If you're making income, then that income is taxable. That's the first issue. The second issue is that income, which is taxable upon receipt. So it's taxable upon receipt. So most individuals are what's known as cash basis taxpayers. And cash basis taxpayer means that income is income to you when you receive it, and deductions are deductions when they are taken. So in the year that they're taken out. So from that standpoint, any income that you make, the tax is due upon receipt. Now this actually represents the genesis of understanding our tax system, because it is the genius behind the legislators that put together the tax code. Now remember, I mentioned in an earlier video, I'll mention again, that it is not the IRS that makes tax law. The IRS is responsible to administrate that tax law. It is actually Congress that makes a tax law. So the genius behind our tax system is that the Internal Revenue Service, for individuals, the Internal Revenue Service enlists as agents, I would say, employers. And so when you work for an employer, that employer takes out what you owe in taxes, and they use a W-9 in order to be able to, not a W-9, what am I saying? A W-4 in a W-9 is for immigration purposes. W-4. They use a W-4 in order to see how much taxes they should be taking out for each paycheck that you take out. But the reality is they withhold your income tax at the source based upon your W-4, and then you receive a reporting of that when you receive your W-2 at the end of the year. So then the employer is responsible to turn that money over to the Internal Revenue Service at the very least on a quarterly basis, depending on how much their liability is. There are time frames that they have to turn that money over to the Internal Revenue Service. That money then goes to the Treasury, and the Treasury holds that information there so that when you file your tax return, the information that is sent to the Internal Revenue Service via the W-2 is matched with the information at the Treasury, the U.S. Treasury, and then your return is processed. So up front, the money that you have withheld at your employer as a source, being an agent for the Internal Revenue Service, makes it so that you, in theory, have paid taxes on what you have received throughout the year. That is the reason why, just in case you're wondering, that is the reason why. Remember, I told you this is kind of in depth, but that is the reason why you are not ever paid interest unless the Internal Revenue Service fails to process your return in a timely fashion. So if you file your tax return and you have a refund coming, your return is marked as a refund return. And because it's marked as a refund return, the IRS has 45 days to process your return and to get your refund back out to you before they have to pay any interest. So the theory is that the amount of money that has been withheld by your employer is actually money that has already been owed to the Internal Revenue Service. And when you file your tax return in the next year, you are actually justifying what you did the year before. So for a cash basis taxpayer, the return runs from normally the return runs from January 1st to December 31st. And then when you file your tax return, and of course, you all know when you file your tax return, right? See, I know a lot of you are out there going, "Oh, April 15th." No, that's not correct. According to the way the instructions are written, your return is to be filed by the 15th day of the 4th month following the end of the tax year. So it could be April 15th, but it could also be affected by, for example, holidays. Or if the 15th falls during the weekend, then it would be extended until the next business day. But if somebody says, "Well, what is the filing date for a federal tax return?" The answer is not April 15th. It's by the 15th day of the 4th month following the end of the tax year. So what you're actually doing is you're justifying, as it were, you're justifying actions that you've taken in the previous year in regard to paying the taxes that you owe on money that you received. And the reason you're paying it in that fashion is because you are to pay taxes when the money is received. The taxes due when the money is received. Now, for somebody who is self-employed or does not have an employer, then there are provisions set up to make estimated tax payments throughout the year based upon how you receive your money in order to make sure that you throughout the year pay in the amount that is going to be owed when you file your tax return. And I can in a later video talk about the how to do an estimated tax return. But essentially what it is that if you fail to make your tax payments as you're supposed to, then the government is going to charge you interest on that which is owed to them because you failed to make your deposit in a correct and timely fashion. So that's kind of a synopsis of what happens in regard to the issue of understanding the philosophy. If you're going to play, you got to pay. Remember that it doesn't matter your age. It doesn't matter. There are income limits as to what you might end up having to pay based upon a number of factors. You know, how you're filing your tax return, your age, the amount of money that you've received. There are a number of issues that govern how you would file, and we will talk in a later video about the filing requirements, the basic filing requirements for a Form 1040 for an individual. That being said, the basic philosophy is if you're going to play, if you're going to receive income, then you are owing the government, and taxes need to be paid on that. Now, how the government actually classifies people that in society as to how they would file their tax return is interesting from the standpoint that individuals. So the government classifies people under what I would call entities. So you as a regular individual, when you file a tax return, you are an entity, a separate entity. If you have children and your children have income, then they would then, because they have income coming in, would represent a separate entity. And either they could be included in your return under certain provisions, or they themselves would have to file their own tax return. You can see this happen, for example, when young people grow old enough to be able to start making some side money by working for Burger King or McDonald's, or some Dairy Queen, or some fast food joint or other type of place where they're making income, but they still live with their parents and they're still not quite old enough to be out on their own. There are special provisions, for example, for having a dependent on your tax return while they're still in college. There are a number of things, and we can talk about that in a later video. But the bottom line is that if they then have to file a separate tax return, they are a separate entity, and that then would have to be established in their filing their own return. When you file a married filing joint return, for example, what you're having is a provision made for two individuals who are married according to state law to be able to file a tax return jointly and combine two entities into one. And normally that won't be broken unless there are some special provisions. And I don't want to go into the weeds because it's very rare, but there are special provisions where a couple married filing joint, only one may have responsibility for liability, and the other can show that they had no knowledge or was aware of what was going on with the taxes. There's a provision to be able to separate them. But the reality of it is you're taking two entities and you're bringing them together to become one, a married filing joint return. So when the IRS looks at individuals in regard to entities, what they're looking at is what is an entity and how does that entity operate as far as the Internal Revenue Code is concerned. Now, the other aspect to that then is that because we're looking at these as individual situations, every tax year is individual to itself. So when I used to work the phones, I have many people that will always tell me, they were ending up owing for a particular year. It was their first time to owe, and they would go back and they would tell me, well, look at my record. I've never had a problem with taxes before. And my response inevitably would have to be that as far as the Internal Revenue is concerned, every year stands on its own. So if you have multiple years where you failed to file your tax return, you have to look at each year separately and treat that year as a separate year in dealing with that particular entity. And then you get into provisions of what what the law says in regard to filing a tax return and statutes, and if a refund was available, was it the return filed according to the law and on time, or the refund no longer exists. There's a number of complexities that could be involved with that, but every year is individual to itself. So when you're dealing with taxes, you need to look at every year specifically and see what happened within that year. And you can understand from just a generic understanding of how life operates. There are times when you make buku bucks and you make a lot of money and you're going to pay a lot of taxes. And there are times when you may not make so much money and you're only going to pay a few in regard to taxes. So every year has to be taken individually to itself. Now, with that understanding, what I'm really talking about then is that the issue of entities, and that means that individuals then would represent one entity. So you're in the case of a man and woman coming together and filing a joint return, they are taking two separate entities and joining them together. There are provisions within the Internal Revenue Code then for how you file your tax return. And those tax returns then categorize, as it were, what type of entity are you. So are you single? Are you married? Are you a widower or a widow? Are you a head of household? Are there qualifications that qualify you to be a head of household? Are you taken on somebody else's return or not? There are all types of issues. So in a later video, I can talk about the different types of filing status and how individuals are affected by the filing status. You can see that it's a somewhat complex issue. Now, but to understand that's just in regard to individuals. Now, there are individuals then that are involved in business, so they file a self-employment return, or they file a return where they have income from other sources. The income that they have from those from being self-employed are attached to their regular return via what's called a Schedule C. And it's on the Schedule C that they take the information off of their individual operation of business, and they put that on their personal tax return and combine that into their personal tax return, so that their business is married to their tax return, and so they're going to pay the earnings on that business activity as an individual, as somebody who is self-employed, as an individual rather than as a business. And so, and an individual can have as many businesses as they like, but they all come together on one tax return, and then they are taxed at the individual rate rather than at a business rate. They also then, of course, have to pay Social Security or Medicare on the income, the net income that they received. And again, I'll do a video that talks specifically about self-employment and the ins and outs of self-employment. But for now, just to say that what you're going to have there is you're going to have business activity which is brought together on an individual's tax return. The other circumstance that you would run into in regard to an individual is that it's possible to bring into an individual return other types of income from business activities which are not related to being self-employed. For example, partnership income comes into an individual tax return via a Schedule E, and is shown it's what is known in the tax world as a pass-through entity, because the partnership of which they have activity is split amongst the partners, and the income comes into each individual partner for them to be taxed at the individual rate. That also happens with what's called a Subchapter S corporation, where again members of the Subchapter S corporation receive an information sheet You know, it's an 1120 K1, and that shows the income that for their portion of activity within the subchapter S corporation. That passes through to their individual tax return, and their individual tax return, then they add that business income into their individual return to be taxed at the individual rate. So even though the businesses are considered separate entities, those entities, that is the partnership and the subchapter S corporation, show up on the individual tax return and are blended into that entity. And then, of course, the same thing we're talking about when somebody is self-employed. The self-employed's business activity shows up on the individual tax return. Now we're going to close this aspect of this video because it's a little bit lengthy with that individual understanding for the individual of their tax return. And the next video will go more into detail about these entities that are more business related. And it's not overly complicated. There are just 3 of them. Well, maybe 4. We'll talk about what the 4th one would be from recent activity within the last, I would say 35, 40 years in regard to how states have allowed an entity to develop, which is called a limited liability company or an LLC. But with that said, let's go ahead and end this video here. So I hope you have a better understanding of when I close out a video saying the basic theory behind taxation for the Internal Revenue is if you're going to play, you need to pay.